Alphabet Inc., otherwise known as Google, ticker symbol GOOG, is currently trading at $188.82 a share. It is up about 6%, and the reason for this is their breakthrough quantum chip. Alphabet shares rose Tuesday after the company's unveiling of Willow, its latest quantum computing chip. And this is big news. There's been a lot of hype around this. We'll talk about this in just a few minutes, and then we'll look at my automated stock valuation spreadsheet to see if Google is still a buy using the discounted free cash flow model, comparable company model, dividend discount model, and Ben Grimm formula for intrinsic value. So let's just have a quick look at this article here. As we said, the company hailed its latest quantum chip breakthrough. Well, as a breakthrough, the company Google revealed that Willow, a quantum computing chip, has performed significantly better on the quantum computing benchmark than its predecessor did in 2019. Willow brings us closer to running practical, commercially relevant algorithms that can't be replicated on conventional computers. We see Willow as an important step on our journey to build useful quantum computer with practical applications like areas like drug discovery, fusion, energy, battery design, and much more, the Google CEO said on X. Even they were talking about it with Musk. Musk is interested in this. We should do a quantum cluster in Starship one day. So very, very bullish. Big news according to Google, but of course that's Google saying that, so they're obviously going to say it's big. But how the market reacted, as I said, up about 6%. Year to date, the stock is up 33%, over the last year 37%, and in the last 5 years up 170%, beating Amazon, as you can see here, and almost beating Microsoft. So, is it to buy? That's the question. So if we put in ticker symbol GOOG, this will load all the latest company financial. If you're interested, check my Patreon. We'll talk about that more at the end. Interested in the sheet, that is. So, $2.2 trillion market cap, a PE of 24, which means it is lower than the market average, which is currently 30.1, which is pretty impressive for a tech stock like this, or a massive growth tech stock, even though it is one of the largest companies in the world. Earnings per share, $7.54, a beta of 1.02, meaning it is just about as volatile as the market. Apologies for that, I'll move that over on that sheet. Analysts do say it is a buy with a target price of $207 a share. Now, they do pay a dividend, 0.43%, meaning you'll get about 80 cents per dividend per share, and that is $4.4 billion they pay out. So pretty safe, 7% and 8% of the net income and free cash flow payout ratios. Buy before the 9th of March if you want to get paid your quarterly dividend. So let's have a look at the revenues here. Surprisingly, all-time highs and still growing. We have the revenues back to 2015 here, and it has basically been a steady growth the entire time. Yes, they jumped up slightly in a certain pandemic year, and then leveled off. Well, not leveled off, they still grew a good amount, but now they've kind of gone back to their prior growth, and looks good in terms of revenue. Net income, are they able to generate more profit? Yes, they are. Sorry, I didn't even say the number. 338 billion in revenue. Now, what are they doing with that revenue? They're generating more profit, as we can see here. All-time highs, 94.27 billion. They did dip in 22-23, but trailing 12 months, all-time highs. Very bullish on Google. Free cash flow, not doing the same. As you can see here, down slightly, 55.82 billion, down from the 70 billion in free cash flow from the prior year. But if we look at operating cash flow minus capex, capex is up and operating cash flow is up. So this is good. You want to see the operating cash flow still increasing. Yes, free cash flow is down, but we can see the capital expenditures. Obviously, free cash flow is operating cash flow minus capex, and you can see here that this is still growing. Shares outstanding, what are they doing? Well, there's been some splits in here, but you can see the general line is decreasing, and they are buying back their shares, rewarding shareholders. Assets versus liabilities as well. Liabilities are increasing, assets is down slightly, but we'll talk about that later. So let's have a look at my discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. So based on averages, we currently have $108 a share. Let's have a look at those numbers and see if we agree. Revenue growth rate, we're expecting about 10%, 375 and 417 billion. Analysts are expecting slightly less. Oh, this is the current year, 350, 490. So still quite a bit higher. So we'll leave them in there. It is. Net income margin's about the same as well. We'll keep that as it is. And free cash flow rate, well, I think They probably should be a bit higher. We'll take the 2023 number, $121 a share. Now, also, Google's weighted average cost of capital is a bit high. If we bring that to about 8.5%, see, $131. Not a buy on the discounted free cash flow model, but not a million miles away, which is good to see. We'll quickly look at the dividend discount model. Because, well, we can't. They've only started paying a dividend in 2024. In a few more years, we'll be able to use this a bit more correctly. So, Ben Graham formula for intrinsic value. This is a way of valuing stocks created by the godfather of value investing, Ben Graham. Looks at earnings per share, P of a non-growth company, AAA bond yield, corporate bond yield, and currently the corporate bond yield, or the AAA bond yield, sorry, is 5.14%. And let's have a look what analysts are saying in terms of growth for Google over the next year or so. We scroll down here. Next year, 12.5% more so than the S&P, which is good. So they are growing faster than the S&P, 12.5. But not a buy, according to this, $135 a share. So pretty close to the discounted free cash flow model. If we look at the stock, hasn't been $135 since, the start of 24. That was a definite buy at that point. But we're talking about the future, not the past. So finally, comparable company model. This is a way of valuing companies looking at their competitors. We're looking at revenue growth rates, EBITDA, net income, profit margins, price of sales, price to book, PEG, Peter Lynch's price to earnings growth, EV to revenue, EV to EBITDA, PE, and we'll also look at forward PE as well. So I suppose I'll just do this on the other screen. If I look at the S&P 500 top constituents by weight, obviously we have Apple, Nvidia, Microsoft, Amazon. Google is number 7. So we'll compare against the tech companies. We'll go Apple, AAPL. And what this will do is it'll load the latest company financial data for these companies. We'll do Microsoft, and then we'll do Meta. And maybe we'll also compare against Nvidia and Tesla as well, just for sort of a more thorough comparison. But as you can see here, enterprise value, these are all massive companies, 3.8, 3.1, 2 trillion, 1.5. Revenue, Google second highest, or Alphabet, sorry, second highest, 340 billion. Only Apple is higher. Revenue growth rate, second highest revenue growth rates. EBITDA joined second. Net income, most profitable. Was not expecting that. 94 billion, more than Apple. Profit margins, lower profit margins. Microsoft and Meta in the 30s, whereas Alphabet and Google, Alphabet and Apple in the 20s, mid 20s. Price to sales, it is the lowest. Market average of price to sales is around about 3.5, but it is the lowest out of these. Price to book as well, market average is around about 5.3. Once again, it is the lowest. PEG, Peter Lynch's price to earnings growth. We want ideally under 1. Only Meta is close. 1 is undervalued, but Google is pretty close. Apple and Microsoft are higher. EV to revenue, it is the lowest number here, which is good. We want lower multiples. EV to EBITDA, lowest as well. PE, lowest, and forward PE, lowest, which puts it, if you would evaluate it at the same as Apple, Microsoft, and Meta, $242 a share. If we go back to the share price, the stock has obviously never been that price. That would be all-time highs and still quite a bit of growth left to go. So that is very interesting. Yes, discounted free cash flow model and Ben Graham formula put the stock at around about 130. But if we're valuing it against Apple, Microsoft, and Meta, which I think are its key sort of competitors, still massive growth left at $240 a share. If I was to just quickly put in, we'll put in just Nvidia and Tesla, and what's the next one? Broadcom is the next largest. We'll do Meta. We'll keep Meta in because it's closer. $400 a share. Obviously, this is a bit different because of Nvidia and Tesla, but you can see here if Google is valued at its sort of at the comparable companies, it is massively undervalued at the minute. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already, and check my Patreon. If you're interested in the sheet, that's the $4 tier. You can buy the more expensive one if you want me to do more reviews for you. And if you just want to help me out, $1.50 a month or £1 if you're English like myself, you can do that as well. Right, guys, I'll catch you next time.